So first we have a stock on a daily time frame where we see that's in an uptrend and it's pulled back. Well, that pullback looks like a bear market on shorter term time frames. So I don't want to buy there.
You got the new trader who wants to implement this idea because they've been stuck on one time frame. What do you recommend they do to get started on implementing multiple time frames?
A longer term time frame, generally a daily is good enough to identify the trade candidate.
Everyone, he just gave you a masterclass really quickly just now on the whole premise of multiple time frames.
You've got to be aware of what are other levels where the stock has had a price history where there might be memory, because price memory means there might be a source of supply there.
Are you going to leave any value for the book so people can go buy the book? That's amazing. Welcome back to the show, everybody. Today is going to be a special day. I got my friend and great trader, Brian Shannon, the author of the book on technical analysis that I recommend everyone to definitely check out. So, Brian, welcome to the show, my man.
Hey, Alex. Good to see you again. It's I think it was Vegas last time, right? Maybe 2 years ago?
Yeah, it definitely was in Vegas last time. And, man, time flies. Was it 2 years ago or last year?
Year and a half, yeah. I had a herniated disc. I remember I was on painkillers. I was hurting.
Oh my God. Well, I'm glad to have you back. And I really want us to focus for a lot of the new traders out there on multiple time frames. So could you let people know what that even is, just in terms of, just the definition of multiple time frames?
Sure. So first off, the book you're referring to is Technical Analysis Using Multiple Time Frames. So I wrote the book about it in 2008. And what I mean by looking at different time frames is, ask somebody, hey, what's the trend? Or, are we in a bull market or a bear market? And maybe the S&P is down 4% in the last week, but it's up 20% in the last year. Well, if you bought a week ago when it was 4% higher, you don't think it's in a bull market, right? It's all perspective and time frame dependent. So if you're down 4% in a month, you're like, what bull market are you talking about? I'm losing my ass over here.
Mm-hmm.
So we have to look at it and say, are you bullish or are you bearish? Well, it depends on what time frame. A day trader can make great money on the long side in a stock that's down 20%, or short a stock that's up 100% and make great money. And people will say, well, the stock's up 100%. How can you make money on the short side? Well, because it's not all, just one direction. We have ebbs and flows in the market, not just on a 1 day time frame, of course, but all over the place. We have trends within trends. And that is what can be confusing to a lot of people. So the way I look at it is real simple to break it down, how to use multiple time frames first, just to conceptualize the idea. Myself as a swing trader, I'm looking to hold stocks for as long as the market tells me. And that generally means I manage risk on a 10 to 15 minute time frame, meaning each bar is 10 or 15 minutes long. I'll typically look at about 15 days there. Now, how I get to that point is where the work begins. We start ourselves off saying, I'm looking at the market and I see a stock that's in this big uptrend. It's up 30% in the last month. It's pulled back 4 days in a row, down 12% from its highs, and then it's turned sideways. So as it's pulling back, I don't want to buy that stock. I always say, don't buy the dip. Wait for strength after. So let it keep pulling back, and wherever it finds support, it finds support. And then as it turns sideways on that shorter term time frame, I look at it and say, okay, now, where's my risk reward? So for that, I might use a 30-minute time frame that goes back a month or so. So first we have a stock on a daily time frame where we see that's in an uptrend and it's pulled back. Well, that pullback looks like a bear market on, shorter term time frames. So I don't want to buy there. As it turns sideways, I look at it and say, okay, if I get involved in this stock, where would my risk go first? Where's my stop? Well, if I buy above the higher high of the last 3 days as it's turned sideways, well, then I'm buying that nascent strength, that first little bit of strength. I'm not waiting for it to take out the prior peak. In fact, I'll probably sell some there. Instead, as the buyers regain control, I want to buy there and set my stop always in the same place. And it's not 3%, it's not 5%, or any other random percent. It is simply below the most recent and relevant higher low. So to me, that means if it made a low of $20 3 days ago. And then yesterday it made a low of 20.50. Today it's breaking past this little resistance at 21 even. I look at that 20.50 low and say, if it breaks that, well, then what I view as an uptrend will no longer exist. So I'm buying at
Mm.
21.01. But if it breaks back below 20.50, we have a lower low. So I'm out. That's my risk management from the start. And then when I look at, when I look to get in the trade, well, that's when I might start to look at the level two. That's when I'll start to set alerts. That's when I'll look at a 5 minute time frame or maybe even a 2 minute time frame to really get in there and fine tune the entry so that when I make that purchase, the trends are aligned. And
Mm.
that means the long term trend is up. We've absorbed that selling. We've gone sideways, and now the buyers are back in control on that 15-minute time frame. They're back in control on that 1 and 2 minute time frame where it's back above the volume weighted average price for the day or whatever it might be. And then the job from there is to continue to manage risk and trail our stops up underneath the successive higher lows. So I gave you a lot right there, Alex. Let's
Hey, we wouldn't be able to do these face-to-face interviews if it wasn't for our sponsor, Cobra Trading. So if you can just give them a few seconds of your time, we'd really appreciate it. Cobra Trading is the go-to broker for day traders and short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. They also have amazing customer service. I've experienced many different brokers, and it's why I use them every single day and why I'm proud to have them as our sponsor. Sign up now by clicking the Be the Trader referral link below and earn 1 free month of software with Cobra and 25% off all commissions. Now let's get back to the show. You sure
digest.
did. I love it though. I love it. He just gave you a masterclass really quickly just now on the whole premise of multiple time frames. But I have some questions for you though that
Yeah.
from that. One of them is people are going to hear you say align the time frames up. However, you also hear people say the whole idea of, if you're going to trade on the 15-minute, use the 15-minute. If you're going to trade on the 5 minute, and I'm just curious since you're execute on the 15, are you only basing your stop on the 15, or are you basing your stop on all the time frames? Are you still looking at all the time frames for your stop as well, or the 2 minute because you're narrowing down even sooner? Like, I'm just curious on that aspect when it comes to narrowing your entry and stop.
Yeah. So basically, I'll use and that's just to make the example easily digested. I'll use, I'm of course I'm aware of the weekly time frame as well and where we are there. On my screen, I have a weekly, daily, 65, 30, 15, and 2 minute that anytime I change the symbol, it populates in all of those. So, but generally speaking, a longer term time frame, generally a daily is good enough to identify the trade candidate. So we're saying,
Okay.
okay, the stock's in a primary uptrend. I'm going to look for an opportunity to buy this. I'm a trend trader, so I'm going to look for an opportunity to buy this. I'm not interested in shorting it and fading the trend. That's not my style. Nothing wrong with that style if that's your style. So the long-term time frame, I identify the trade candidate. The intermediate term time frame, 30-minute, 15-minute, maybe even 65-minute. Okay, so it all depends on how much you need to see. That's where I look at and say, what's my plan for a swing trade? What do I see as a potential place this stock might go? Well, again, using our stock we just bought at 2101, if the peak for 7 days ago was at 24, the definition of trend is higher highs and higher lows. I expect it to at least go back to that 24. It's not a price target. It's just a level of interest where most likely I'll sell a piece of it there to the breakout crowd because the people who buy at 24 when it was just 20 and a half, they're late.
Yep.
So I will always want to sell some to those people. Anyways, I'm getting ahead of myself there. Identify the idea on the daily time frame, establish the risk reward on the intermediate term. And again, that could be 65-minute, 30-minute, 15-minute, whatever you need to see. And then execute the order on the shorter term time frame. So execute on the 5 minute, the 2 minute, or even the 1 minute if we're in the first 15 minutes of the day. But my stop will be based on that definition of trend that I established on the intermediate term time frame. So
Mm,
identify, risk reward, trade execution. That's a minimum of 3 time frames.
man. Okay. So are you going to are you going to leave any value for the book so people so people can go buy the book? That's amazing. I
Oh,
appreciate you
yeah. I
sharing
mean,
that.
there's a lot more in there, of course,
Of
but
course,
sure.
yeah.
And that, yeah.
I love that you shared all that. And I was just teasing you because the book is amazing, so everyone needs to check it out. But going back to for people who are fairly new, let's say, is this something that, because they're probably asking themselves, is this something that they can implement on any strategy, no matter, because you mentioned trend following, does it matter what strategy you do? Should you be implementing multiple time frames?
I think so. I think even if you're, the people who sell short these spikes in the crazy stocks, you've got to be aware of what are other levels where the stock has had a price history where there might be memory, because
Mm,
price memory means there might be a source of supply there. So you want to either wait for it to get up to that level and start to, so you're looking at this stock, it's up 150%, but it's breaking out to all-time highs. Who knows how high it can go? Other an example that would be example A. Example B would be the stock breaks out, rallies up 150%, and it's pegged right up against a declining 200-day moving average or a prior big band of support, something that the market will value. You
mm,
need to be aware of that. You can't just be looking at your 1 minute chart. You got to say, okay, now here's my zone. This is a place where it might make sense for the stock to begin to pull back. But so I have my idea. I'm not going to trade in here yet. Instead, I'm going to look at my 5 minute time frame, my 1 minute time frame. I'm going to see, hey, this thing's above the volume weighted average price for the day. It's ramping higher. It's above a 20-minute moving average or whatever it is you use on those shorter term time frames, not you specifically, whoever this is. And then look at it and say, now we're in this level of interest from the higher time frame. I want to anticipate in here. And that's what the intermediate term time frame is, anticipate the trade. And as I say, so we identify the candidate on the long-term time frame, we anticipate the trade, create our risk reward, and we participate once we have evidence on the short-term time frame that our plan is showing us, hey, yes, it's breaking past that 21 point. This looks like a low risk point where the buyers are regaining control. So I
mm.
want to get involved here. I'm not going to wait for volume. I'm not going to wait for it to be on CNBC or some analyst to say something or to start trending on stock twits or Twitter. It's lonely there at the purchase price a lot of times, but
Mm,
you're getting in right at the beginning, and that's where having confidence in your system and your strategy and technical analysis and how it works pay off. And you in advance, you say, sure, it's lonely here, but if it goes below 2050, I'm out. I just don't care what happens after that. I don't care what news comes out. I don't care what you know Chairman Powell says. None of that stuff is relevant. It's always price based because only price pays.
mm. Now, I know people are going to hear you say this, and they might be thinking to themselves, okay, I have my level in the line in the sand where I know I want to get in. It's at a key level of support. We're seeing higher lows. We're seeing 2050s at key level. And now I'm going down to the smaller time frame as it gets there, it gets there. And let's just say on the smaller time frame, it is, it was at the open, the first morning, half of the morning, it was very
Mm-hmm.
bearish and it broke under 2050. It went to like 2025, and it broke under, held all morning. And then now it's setting up like a really nice ascending triangle setup. And it's actually about to break out above 2050. Is the play in their head over because it's under 2050, or should they pursue that type of a setup? What is your advice for those type of plays?
That's a really good question, Alex. And the thing is, once you have that initial plan established and the stop gets violated, to me, the trade is over.
Mm,
I can look at the trade again and say maybe there's something else there. But my plan was if it broke below 2050, there's a problem.
mm,
So I can't just ignore that and say, maybe it broke to 2048. And then the question is, did it just run up to 21 in 10 minutes and expend 52 cents of energy that quickly? Because I don't want to chase it there at that point.
mm,
To me, to me, it's a little bit of a fake out. I'd rather let it go because how did it get there is just as, or maybe even more important than just getting there. Instead, I'd
Mm.
rather see it go to 20.55, let the chasers chase it. Then it runs out of momentum short term. It pulls back to $20.28. It hits the daily VWAP for the day and it bounces from that daily VWAP. I'm going to buy it at $20.32 with my stop at $20.24 maybe. So I'll look at more as a momentum play because, okay, that bigger level was violated. It could be now in play. We had
Mhm.
our little games being played by people trying to, establish their position and fake people out. But now I'm going to trade it probably with a tighter risk management because
Mm.
it's a different trade. And that's the art of trading, and that's what you're getting to, Alex, is the art of trading versus the science of technical analysis. We can lay this out and look at all of our textbook
Mhm.
examples and say this looks perfect and decide, hey, I'm going to put my whole account into it.
Yeah. Yeah.
And we know how that always works.
Yeah, don't do that. Don't do
Yeah.
that. I'm curious on for the new guy, the new trader who's wants to implement this idea because they've been stuck on one time frame. Should they? What do you recommend they do to get started on implementing multiple time frames? Should I do all of them right at once? Like, how should they approach that?
No, I would say, okay, so if you're a day trader and you've been trading just off of 1 minute charts, well, then add a 15-minute chart and try to get some perspective of what this bigger picture is and see how the time frames flow together and then how yesterday's high became this morning's low. Just basic things like that, or yesterday's volume weighted average price. This morning, it had strong momentum yesterday. It pulls back perfectly to yesterday's VWAP, gets back above daily VWAP, bam, off to the races. Be aware of those types of things because you're really limiting yourself to just to one time frame. You're just not seeing the picture. You're,
Mm.
as they say, your face is too close up against the glass
Mm.
to really
And
see.
and you mentioned VWAP, volume weighted average price. I know that's one of your favorite indicators, and especially anchor VWAP, which would be for a whole nother episode in the
Right.
future. But on the multiple time frames, are you also? It seems like you're using. Is there special indicators like the? Is there an indicator you can use in all time frames? Does it matter? Just curious.
The VWAP and the anchor VWAP I have on every time frame. I will say this, that for swing traders, the absolute best thing that I have used, and I've been very loud about it over the last 15 years on Twitter is or X is the 5-day moving average. I will not buy a stock if the 5-day moving average is declining. I will not short a stock if the 5-day moving average is advancing. I want to see, so going back to our example, it pulled back from 24, it pulled back 4 days in a row, went sideways for 2.5 days. That 5-day moving average has come down and flattened out. We probably banged up against it 4 days ago on a little false rally. Well, it was below that, and or maybe even up through it slightly. If the direction of the 5-day moving average is declining, I'm generally not interested. I'm going to let it settle down. I'm saying this is just a spike up. It still needs to settle down. In that first book that I wrote, I wrote about the dropping a ball off the 15th floor. That initially it'll bounce up and maybe bounce as high as the 12th floor. The next bounce, it loses energy and it bounces up to the 8th floor. And then it bounces to the 5th floor, the 3rd floor, and then it just dribbles out. And that's what volatility does. After we have
Mm.
that, pull back down from 24 to 20, it might rally up to 21.20, pull back, make a lower high at 20.75, then 20.50, and then we have those higher lows. And that's how it comes together, is that compression of energy within there. And once that 5-day moving average flattens out, that's just, I can't tell you why, but that is, to me, the best indicator of whether or not to give the benefit of the doubt to the buyers or sellers on that intermediate term time frame.
Well, look, Brian, I mean, you shared so much valuable information today. I want people to be able to find you and ask any questions or at least find your books and read as much as they can. Where can I get more information about you?
Just type my name into Amazon, and on Twitter or X, it's at Alpha Trends, ALPHATRENDS. That's where I put out a lot of stuff. My free weekly video, I post it there. So that's the concise place to go.
Perfect. And we'll provide those links below for everyone. And other than that, Brian, I appreciate you being here today, my friend.
My pleasure, Alex.